Get ready to enter a brave new world with your host, Vasant Dhar.
So how do you pick the stocks you buy? Is your attention driven by the latest news on the internet, your friends, or prods from your investment platform? Is your buying behavior different from your selling behavior? Do you understand how, quote unquote, the market works and what kinds of people and machines you're up against? These are fundamental questions that are worth considering if you're interested in money and investing. Joining me today on Brave New World is Terrance Odean from the University of California at Berkeley. Terry's a professor of finance at the Haas School of Business and has done some of the coolest work in the field of behavioral finance, which is all about how psychology impacts financial markets. He studied several generations of human investment behavior and has some recent insights on younger investors on platforms such as Robinhood, who've been very active during the COVID era. Terry has a way of explaining finance and investor behavior with great nuance that is easy and intuitive to understand, but it wasn't obvious before he told you about it. It's always a treat talking to him. Terry, welcome to Brave New World. I am delighted to have you on the show.
I'm happy to be here. Thanks for inviting me.
So you've grown up with the field of behavioral finance. So, tell us how behavioral finance differs from classical finance and what induced you to get into the field when you did some 30 plus years ago.
Sure. So when I came into the field, the dominant paradigm in finance was that people were rational in their investing, in their dealing with money, and those who weren't, they sort of canceled out. They behaved randomly, not systematically. So nobody thought that every single person was completely rational, but the dominant approach was that biases didn't affect the markets because everything washed out. And I think this came, it's not like finance had always been that way or economics had always been that way. I believe Keynes once said that the market could remain irrational longer than you could remain solvent. So there were certainly economists in the past who have talked about psychology and human behavior. To some extent, I think what happened was after World War II, you had von Neumann and Morgenstern and others developed axioms of rational decision-making. And these were reasonable assumptions about how a rational person would make decisions. And with these, economists were able to build sort of formal models of a wide variety of situations in which, how would economic agents behave under these situations and what would it mean for economics? So there was this appeal of being able to have formal mathematical models. Now, I think that part of what went on is what Danny Kahneman wrote about in Thinking Fast and Slow, one of the many things he wrote about, which was that there was the sort of substitution took place. So if you think about what economists, for the most part, really want to do is understand how real markets work. And what this formal modeling based on these assumptions of rational choice, rational decision-making, what they did was they answered a slightly different question, which is how do economic markets work? How do economies work? How do these things work if people are completely rational in their decision-making? Now, I suspect at the beginning that distinction was clear to a lot of people, but over time, in finance in particular, I think more so than in economics, there was a tendency to sort of start to treat the problem you solved as the problem you started off wanting to solve. And that's the substitution. Kahneman talks about that sometimes when you have a problem that you can't solve, you find an easier one that you can solve, and you sort of ignore the substitution.
Right.
So we ended up in finance with, with these models based on very, very rational agents. And you can do a lot with these models, but in many situations, they're wrong or they're not sufficiently right. They're elegant, they're simple, they're approximations, but I think the field swung too far in that direction. In the 80s and just before I started to study finance, there was a lot of research in finance on anomalies. So part of what came out of the 70s and the sort of more mathematical approach to finance was the efficient market hypothesis. And it made a lot of sense. If you had a lot of rational agents, prices would sort of aggregate to some sort of weighted average of what everyone believed. And the underlying sort of assumption was, well, people have noisy signals, but when you start putting it all together, a lot of the noise from their signals cancels out, and you end up with as good of a price as anyone could have. And then the efficient market hypothesis, though, implied that you shouldn't be able to be doing things like predicting returns from past information. And there were a lot of things that were implied, and then that researchers started to find out, well, that's not true. And so there's this literature on anomalies, and the whole idea of, why anomaly? Because we have a model, and what we're observing is anomalous under that model. It doesn't fit. And that started to, in a way, soften academic finance up for behavioral finance. So you sort of say, well, we're seeing things that are inconsistent with the theories we have, so maybe something's wrong with our theories. I think to some extent also market events matter in terms of influencing academic finance. The crash of '87 came as a shock to a lot of people. And even though the market recovered within a couple of years, there was still this feeling of our models of markets don't include, prices dropping 25% on the whole market in a day. And even there was also an understanding that academic finance, in particular portfolio insurance, had contributed to that crash. And while my advisors, Hain Leland and Mark Rubenstein, were the guys who invented portfolio insurance. And they did understand that there were circumstances under which it might not work. And they talked about that. But I think it still came as a shock when everything melted down in October of '87. So let me say how I got into finance. I got into finance because I came back to school late. I dropped out of college 5 months before I was supposed to graduate in 1971. And many years later, when I was 37, I was married, had a daughter, lived in Berkeley, and decided to come back to school, finish my undergrad degree. I originally wanted to study psychology, and one of the people at admissions who I went down to talk to at Berkeley said, well, we don't usually take senior transfers, and asked me why I want to major in. I said psychology. She said that it's probably not the best choice because we have so many psychology majors, pick something else. I immediately said statistics. I'd been working for a statistical analysis software company. I said statistics. And she said, there's a good chance you'll get admitted. So I got admitted. I was majoring in statistics. I thought I would get a PhD in psychology. I took some psychology classes, and I met Danny Kahneman. And I actually knew who Kahneman was already. I had read about him and had a book of his. But I saw he was teaching at Cal. I took a course from him, got to know him very well, and went to his house one day to talk about grad school. And my intention was to say, Danny, can I be your grad student? And he talked me into going into finance that morning. He said, he gave a pretty cogent argument on multifaceted, but fairly simple. He said, well, the research in judgment decision-making, it's becoming a more mature field. Amos Tversky and I picked a lot of the low-hanging fruit, and others, Paul Slavic and other people, Baruch Fishoff, other people who were working in the field early on. And he said there are going to continue to be innovations, but they'll come less frequently, they'll be more technical. He said behavioral finance hasn't taken off yet. It's there, but it's not happening. If you go into behavioral finance and things work out well, you can be one of the earlier people in the field. Not the earliest, but early on, and that's a good place to be in academia. And then he said, if you try to make a career in behavioral finance and get your PhD and the field doesn't take off, you have a PhD in finance. As a backup plan, you can go into industry and make more money than you would have as an academic. And I thought,
sounds like a good plan.
Yeah, that's not a bad backup plan as things go.
Yeah.
And even there, he was right. He was right on both things. So for me, the first worked out well. I was doing behavioral finance at the time when suddenly people got interested in behavioral finance. But the other part was true too. I had friends who chose not to go into academia, who went to academia and left academia, and they all have a lot more money than I do. So, the backup plan, it would have worked.
Small world. I had Danny on the pod exactly a week ago, and that was partly in response to the fact that I reviewed his book, Noise. So the things you're talking about are actually very fresh in my mind. This notion of, where people substitute a problem with a similar one, but then they also end up mistaking similarity for probability. There's just so much richness in this new book. And I'm sure we'll come to some of his, findings in Noise in a little bit. But let's go back to, so you got into behavioral finance relatively early. What did you find in terms of how people actually behave as opposed to how rational agents behave? And just to kind of widen the question, I'll say, and what about human behavior, I guess, has remained invariant over these 30 plus years?
Sure. So I started the PhD program at UC Berkeley with the intention of doing research in behavioral finance. I chose Berkeley really because it's a very good school and I lived in Berkeley. I owned a house here already. There were very, very few people doing behavioral research in finance at the time, and nobody at Berkeley, none of the professors that were doing that. Danny introduced me to a few people, Hersh Shefrin, Meir Statman, Richard Thaler. And so I did have people, I could ask questions if I needed to. After the coursework for the PhD, the couple of years of coursework you do, and I was starting to think about a dissertation, and I was auditing a class taught by George Ekerlof, who's, does behavioral work in economics and later won the Nobel Prize in economics. And auditing this class, and George stopped his lecture a little bit and said, those of you, this was a course for PhD students on macroeconomics. And he said, those of you who intend to do empirical research, he said, don't just find some tired, worn out database and try to wring one more dissertation out of it. He said, find a question that you want to answer. And then ask yourself, what data do I need to answer that question? Go out and get the data and, do something new. So I was sitting there and I just stopped listening to the lecture and started thinking. And I had read this paper by Statman and Shefrin on the disposition effect, the tendency to hold on to losers and sell winners. And it was a mostly theory paper and it was largely based on Kahneman, Tversky's work on prospect theory, on issues around regret. That's how it was motivated. But there wasn't much. There was a small empirical section, but not much. And I thought, I know people behave this way. I had traded, before I was an academic, I had been trading stocks. And I said, well, that's what I did. And I don't think I was unusual. And I've seen other people do it. I'm sure people do this. And I thought, well, what data would I need to show people do this? And I thought, well, if you could get trading records, you could show that people were hanging on to their losers and selling their winners. So I thought, and if you got the trading records, and I thought, well, and individuals are more likely to do this than institutions, because institutions have institutional learning. They're more likely to tell the manager of a fund or something to have a rule that says, if something drops 10%, you have to sell it so as to overcome the bias. I thought, well, but individuals, they're not going to be that sophisticated. And I also thought, well, ideally, I'd get data from a discount brokerage firm, because then there's also not the issue of, was it the advice giver or the person whose money it was who made the decision. So I decided, well, I'll just get data from a brokerage firm, which was a fine decision. It took me 11 months before I finally got a brokerage firm to say yes. I wrote letters to like 30 firms. I called firms. It's a long set of stories. But after...
Yeah, I can imagine. Yeah.
And, it was no. Even the firm that gave me the data turned me down 4 times before I finally found someone at the firm who said yes. But then I had data, and that was great. So I wrote the paper showing that, indeed, people tend to hold on to their losers and sell their winners. And there's various ways you can think about why they do that. But I think the simplest explanation, and this does tie into prospect theory and things, but the simplest explanation is that you feel good when you sell for a gain, and you feel bad when you sell for a loss, and you like to postpone feeling bad, and you tell yourself it's coming back. It's just a paper loss. It's going to come back. And so it just feels better. So I got the data. I showed that. I had written, the first paper I wrote was actually a theory paper about overconfidence. There was a lot. So I'd read a lot of the judgment decision-making literature. I took a couple of classes from Kahneman. And there's a lot written about these sort of self-serving biases, including overconfidence. And I thought, well, probably individual investors are overconfident in the sense that they think they know more than they do. And so I wrote a theory paper and said, well, what happens in markets when the investors are rational in all other respects, but they think they know more than they do? And you get more trading than you would otherwise. You get a little more volatility. People earn less than they would have if they were fully rational. So I thought, well, I've got the data from the discount brokerage firm on these people. Let's see whether, one of the implications was that people would trade more than they should. I said, let's see if people are trading too much. Now, we don't know exactly how much people should trade. So I said, well, one measure would be if you sell one stock and buy another, on average, you'd like the one you buy to outperform the one you sold by enough to cover the transactions costs. Now, and I expected to find that the stocks people bought would do slightly better than the ones they sold, but it wouldn't be enough to cover the transactions costs, because that's sort of what my theory said. To my surprise, I found that these investors, on average, the stocks they sold went on to do worse than the stocks they bought went on to do worse than the ones they had just sold. And that was before factoring in the transactions costs. So they were definitely trading too much. I teamed up with Brad Barber after I got my PhD, and I was able to get a second data set from the same brokerage firm. And we followed up on a few more papers about overtrading, overconfidence. We showed that we had a paper called Trading is Hazardous to Your Wealth, showed that people who traded more earned less. And this is individuals. Yeah, I'm not talking about high-speed trading firms or something like that.
And did trading activity also increase with the increased access to more sources of information that was happening during that time?
Well, yeah, we have another paper about attention called All That Glitters. And the logic here is it actually started off, Brad and I said, so how do people pick the stocks they buy? And if you're an individual investor, there are hundreds or 500 choices in the S&P 500, slightly less than 5,000 in the Wilshire 5,000, but there are a lot of choices. And what we figured was, well, we know that people don't go home at night with folders full of, the reports on different stocks and study them and sort them and say, I like this one, that one. What we thought is that most people probably wait for a stock to catch their attention. Maybe they read about it on the Wall Street Journal. Maybe in the 70s, they heard Louis Rukeyser mention it on Wall Street Week, or today they're watching Kramer, Mad Money with Kramer. But somewhere, or their brother-in-law comes over, but something brings it to their attention. And then they say to themselves, do I like it or not like it? So you and I might both be individual investors. And we open up the Wall Street. We don't even open up. We look at the front page of the Wall Street Journal one day and we see 10 stocks listed. We read a little bit about them. And let's say I'm a momentum investor and you're a Graham and Dodd style, fundamentals investor. Well, I see something, it's a growth stock with positive earnings surprises for the last 3 quarters. It appeals to me and I say, I'm going to buy that. You don't like that stock. You see another stock in there, maybe it's been out of favor, it's got really good fundamentals, and you say, I like that. But what's happened is we start off with a choice set of like 5,000, say, attention brought it down to 10 or 12 stocks, and then beliefs and preferences entered in. On the sell side, attention doesn't matter so much, and that's because most of these individual investors only own a few stocks. They have like 3, 4, 5 stocks. So if you decide you're going to sell, you can easily consider each of your 4 or 5 options. And generally speaking, selling is a backward-looking activity. People sell their winners because it makes them feel good. They sell because of what happened in the past. Some people pay attention to taxes, and come December, they sell they'll sell their losers to get a tax write-off, to pay lower taxes. But in both cases, those are backward-looking events. So we didn't think that attention would matter as much for selling. And we also didn't think attention would matter as much. That doesn't mean not at all, but as much for institutional investors because they have more attention. They have all day. They work in teams. This is their job. They use computers, which help them filter through things. They own much larger portfolios often, which means the stocks, the universe from which they sell and buy is more closely matched. So the upshot is we came up with the hypothesis that individual investors would tend to be, as a group, on the buy side of the market for attention-grabbing stocks, which, go back to information, would be oftentimes stocks for which there's a bunch of recent information. And that's exactly what we found. And it's rather incredible. We did this with 3 different brokerage data from 3 different brokerage firms to begin with in the original paper. And then we went back and used TAC data, 18 years of TAC data. And if you sort stocks on measures of attention, like one measure would be abnormal trading volume, figuring that if people are trading a lot, they must be paying attention to something. You get this monotonic trend that the higher abnormal trading volume is, the more the individual investors are on the buy side. Not that necessarily just that they're trading more, but that a higher percentage of their trades are buys. So let's go back to the question you asked about human psychology, which is, has it changed much? Probably not. Right? I mean, not the deep fundamentals. What changes is the environment. And the environment in which individual investors find themselves is dramatically different than it was 50 years ago. Even 20 years ago, but let's go back 50 years. You go back 50 years, your news sources are You know, Wall Street Week with Louis Rukeyser on Friday evenings. You might get 10 minutes of the business news on the three national networks. And you get your local paper, and maybe if you live in New York, you get the Wall Street Journal as well. So
And maybe Barron's.
And Barron's. Yeah, no, I agree. You could be getting, there are a couple of, but how often do you get Barron's?
That's right, once a week.
Once a week, exactly. Yeah. So there were fewer sources, they were far less immediate, and they were, and there was a lot less heterogeneity in the information you got. There might be some disagreement, but there wasn't a lot. I grew up there, I was around for all this. Okay, so information was much simpler, slower, and homogeneous. Commissions were regulated still, so it was very expensive to trade. So the first big change is probably 1975, where commissions get deregulated. You start to get discount brokerage firms like Schwab. There's a lot of competition, and the competition in commissions is very closely tied to technology. So Schwab, for a long time, its technology was all about having lots of operators who could answer the phone when you called. In the 90s, that started to shift, and people started to trade online, and that lowered the cost, and that lowered the commissions. There was also an innovation. I met Bernie Madoff at an academic conference in Memphis I think it was 1994. And this was before he was the Bernie Madoff, of scandal. He'd been the chairman of NASDAQ, and he had a business that was making money by buying order flow. So one of the technological innovations was that NASDAQ market makers and wholesalers would pay discount brokerage firms for the opportunity to clear their trades, to be on the opposite side of those trades. And that's how Madoff first made money before he went into fraud. So that lowered commissions also. So you get commissions going down, and now it starts to feel, and then information sources start to proliferate. Now you have cable TV, a lot more news sources. By the late 90s, you could actually be watching market-related news all day long. So you're getting a lot more sources of information. You're starting to get a little more heterogeneity in the information you get. It's getting easier to trade. E-Trade had an ad in 1999. And it started off as it's 2 a.m. and you want to place a trade without waking your baby or your broker. It's time for E-Trade. I used to tell my students, when you wake up at 2 a.m. and you're in a cold sweat and want to sell all your stocks, or you're all excited about some, little high-tech stock you read about the day before, go back to sleep. There's only one thing to do at that point, go back to sleep. But, it got easier to trade. You could trade online. You didn't have to call someone. You didn't have to explain to your broker why you were doing something so stupid. It got easier to trade. It got cheaper to trade. And there was more information around that would sort of prompt you. And now, since the late 90s, what's basically changed, a couple things. One, all of those things have just become more so. Now the proliferation of information is phenomenal on the internet. It's not just 24/7, it's just thousands of sources. The heterogeneity is huge. People disagree outright, sometimes extremely rudely. The ease of trading is just remarkable. I just wrote a paper with some colleagues about Robinhood, and I opened up a Robinhood account just to experience the phenomenon. I knew it was going to be easy, and yet I was shocked at how easy it was. I got out my phone, boom, 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 boom. I've got an account. within 5 minutes, I'd opened up an account. I transferred $500 from my bank account into my Robinhood account. And I thought I was going to get a message that said, in 3 days, when your bank transfer clears, you can start trading. But no, I could start trading right then. I placed a small trade, and confetti fell down on my cell phone screen. I'm told the confetti's gone, but I got in early enough to get confetti. So it's really easy. The commission is zero. That doesn't mean there are no transactions costs, but the commission is zero, and that's the transactions costs that the individuals are focused on. And there's lots of sources of information that keep drawing you back to the market. And with Robinhood, I finally turned them off. It was driving me nuts. But all day long, I would get text messages that kept bringing my attention back to the market. It would say, oh, this stock you own is up this much, or this is down, or this just happened. And that kept bringing my attention back, and my attention's back. And I think, oh, maybe I'll trade for a minute. I'm kind of bored. So, yeah, well, trading as a cure to boredom.
COVID's been a pretty big driver in all of this, isn't it? We're sort of getting to your Robinhood paper that I want to get into here.
Yeah, I think it gave Robinhood a boost. People, and that mostly, but not exclusively, means a lot of young men, were home. And COVID did some strange things. It left some people in dire straits economically, and others really not. Many people were able to transition to working at home. They didn't lose income. They may have gotten one of the stimulus checks, and their expenses were down. They weren't traveling, they weren't going on vacations, and they were bored. And then, the market went up, and oftentimes the market going up there's a snowball effect. We saw in 1999, people got excited about internet stocks. They bought them. And they bought them. That drove the price up. And then more people got excited. They bought them. That drove the price up. And you do get a little bit of this snowballing. And it just gets more and more exciting. So,
yeah, I must admit I got suckered into that as well, and did not escape the .com crash completely unscathed. Yeah, it's very tempting to get in and to feel like you need to do something. There's a friend of mine who's an options trader, and he said the trouble with options traders is that most of the time they should be doing nothing, but they just feel this need to do something, with their time, whereas in fact the best thing to do would be to do nothing.
Yeah, I got an email once from a reporter on a day, I forget, this is years ago. The market, something had gone on in the market. And he said, what should investors do? And I said, well, if you're on the West Coast, it'd be a good time to go to the beach. And if you're on the East Coast where it's a bit colder, you might want to go to a movie. But whatever you do, don't trade. Just set it aside and, just relax. Don't trade in a panic. The market had dropped that day, but
Yeah. So let's fast forward to where we are now, which you've laid out in terms of the heterogeneity, the ease of trading, the fact that it's zero cost because of payment for order flow.
By the way, it's not zero cost, but it looks like it is.
That's why I said in quotes. And one of the other things I wanted to talk to you about, and this is sort of driven by an article I wrote in Market Watch, trying to tell young people not to day trade, but if they feel a tendency to want to trade, to have a system. And I got quite a few responses to that, including from one guy who said, I'm one of those guys that has a system, right? One of those few people that has a system. And he says, I trade the XLF 30 times a day because I can predict the next quote, but I've been kicked off the platform. They don't want me because I'm hearing that people are complaining that we don't want this toxic kind of order flow. And so his conspiracy theory version was, once in a year, someone from Citadel and Schwab get together in the pizza shop in Vegas and decide on, what the cost will be for order flow. So I'm assuming that how much, let's say, Citadel pays different brokers will vary depending on what the trading behavior is. And I'm just curious about the behavior of Robinhood users versus Schwab and E-Trade. and how it gets monetized?
So I don't remember for Citadel, but I've looked at the records of what different brokers are getting paid for order flow. In some cases, the wholesalers are paying the same price to everyone, but there were some cases where Robinhood was getting paid a much higher payment for order flow, per order than other discount brokerage firms. And Clifton Green and his co-authors have a paper. It's not. I didn't write it. I read it, but they say that the quality of execution, basically the effect of the spread being charged to Robinhood investors, is often higher than to investors from other brokerage firms, which would be consistent if you're charging. If I'm a wholesaler like Citadel, but I'm not necessarily saying Citadel, but if I'm a wholesaler like Citadel, and I'm paying for order flow, well, if I'm paying a lot for order flow, I'm going to try to make sure that I'm getting a bigger spread. And I think that Robinhood got into some previous trouble for negotiating with a wholesaler about the trade-off between quality of execution, like how much price improvement there was, and the payment for order flow. But it's much cheaper to trade today than it was 50 years ago, like dramatically so. But it isn't free. So people should realize a zero commission doesn't mean that free. You end up paying for it in execution. That doesn't mean, like I say, it's cheaper. It's just not free.
So trading is not really free, but are the lower costs for retail investors and the current attention directing sources helping them make more money? Or are they coming out behind, like in your earlier study where stocks people sold did better than what they bought? I get the sense that most Robinhood investors aren't making money, or relative to the market anyway.
That I don't know the answer to, and I suspect most of them are making money in the sense of they've been in the market at a very good time to be in the market. So if you benchmark them against their Wells Fargo checking account, they're doing great. If you benchmark them against a basket of high growth stocks, they're probably not doing that well, and I don't know how they're doing against the S&P 500. Our study looked at herding events. We looked at days in which there was a big increase in the number of Robinhood users. We had to go with changes in users because that's the data that were available. So we couldn't actually see the Robinhood investor trades. But we found that on days in which there was a big increase in the number of Robinhood users, they coincided with big increases in the price of a stock. And I'm talking about for an individual stock. And usually you'd see the stock price starting to go up. You'd see a lot of Robinhood users pile in. You'd get up near the top. There'd be a lot of buying taking place. And then over the next few days, the price would go down, though not back to the original price. Okay, so it wouldn't fall all the way. We estimated, though, that on average, the Robinhood users were losing money on these events, although without any question, the people who got in early made money. So, I'm not going to sit here and say nobody's making money at Robinhood traders. Of course, some of them are. But we just tried to look at the average outcome.
By early, you mean before the herd effect started, or right at the beginning?
Exactly. You could think about like a party. Some people arrive at the party. Some people hear a rumor there's a party over on Avenue E at about 1 a.m. and they get there around 2. And as they're coming in, they notice a lot of people are leaving. And then they hear the sirens in the background and the cops are coming to shut it down. So, the people who arrived early had a better time. We see a lot of buying of these stocks after the price has been run up a lot. And I would say there's one other technological change that is pretty interesting, which is I've written papers on the herding of individual investors with Brad Barber and other co-authors in the past, where and other people have documented this too, that you see investors buying the same stocks at the same time and selling the same stocks at the same time. And when we wrote these papers, decade or so ago, what we thought was that people were responding to the same external signals in the same way. They were responding to the same previous price movements or maybe the same news. But they weren't coordinating. They weren't responding to each other's trades because they couldn't observe each other's trades. You might observe there was a lot of trading in Tesla today, but you wouldn't know who was doing that trading. That has changed. Now you could go to forums like Wall Street Bets, and people are writing things like, I bought Tesla today, and here's why. Or I'm going to buy GameStop, and here's why. So now it's possible, the mechanism, the technology is there for a large number of individuals to react to what other individuals are saying that they're, claim to be doing. And it's very fast. So the feedback loop, the information is much faster. And probably the feedback loop's a little faster too. The feedback loop, I mean that these people buy, the buying drives the price up, and then suddenly people are buying again. But the information side is what's new. Being able to go on a website and hear a rationale for buying a stock and see a lot of things written by people saying, I'm buying it, well, I'm buying it, I'm buying it. And then you feel like, well, I'm going to buy it. And that there was no mechanism quite like that, 20 or 30 or 40 years ago.
Given your findings, is a good strategy to treat that as a contra signal? This reminds me of like a Seinfeld episode, where George is talking about if every instinct I've had has been wrong, then I should do the opposite. I should be the anti-George, right?
Oh, so by the way, just for it's worth, I have a clip of that. I show it to my students after I talk about all the research I've done on individual investors. I say exactly that to them. I say, so if you always get it wrong, what should you do? And I say, watch this clip. And George says, do the opposite. And I say, should you as an investor always do the opposite? I say, in most cases, no. You should probably just buy a low-cost, well-diversified index fund. It's boring, but it's a good strategy. And if you really enjoy trading, take an amount of money that you can afford to play with and trade with that. So if you're 25, that could be everything. You're 25, you have a good job, you got $10,000 or $5,000, you're willing to lose it, fine. But if you're 55 or 55, you don't want to be doing that. You don't want to end up like the Enron employees who, when they lost their job, lost all their money, all their life savings because it was all Enron stock. You don't want to, in my opinion, no, don't be a day trader with money that you need. Don't even try to be too smart with money that you need. That's my view. By the way, I've studied day traders. My co-authors and I have looked at day traders in Taiwan. There are a very small percentage that predictably make money. Where you can look at this person's track record and say, statistically, this person's going to make money over the next 3 months. It's like, under 1% or around 1%. Mostly they lose money, and mostly they learn very slowly. Like we see people who have been losing money consistently for years who are still day trading. Yeah, I mean, should you take it as a negative signal? As I say, with the money that counts for your retirement, my recommendation is don't play games. And with the money that you're having fun with, whatever makes you happier, Vasant, whatever makes you happier.
Indeed. I believe investing is a very personal thing, but I certainly don't trust my gut. And I try and induce people to think the same way. I mean, it's almost like if I think about it, right? If I could actually see all of this stuff happening on Reddit boards, and it's almost like humans are like lab rats, right? If I could actually observe human behavior at scale and what they're saying and what they're doing and stuff like that, which a machine can do, my own end game here is humans don't stand a chance. Unless you have a system, just go into the index and chances are you'll do fine. By the way, on this, I just want to push on one other thing. So what happens in a world where information is continuous? So at the moment, it's still discrete, right? You have end of day prices, you have earnings releases, all that kind of stuff. Whereas the world is getting heavily censored. We're observing everything through vision and language and all of that stuff, right? So what happens when we have this 24-hour continuous information scenario, which I sort of see us heading towards?
We're certainly getting close. I mean, you can get 24-hour information.
I guess the end game of that is that there are fewer surprises.
Two things go on, I think. One, you get fewer big surprises because, if you only reveal information every 3 months and you really keep it under wraps between then you're going to get a bigger bounce. That's part of the reason that companies keep, having sort of like advisory things. They prefer not to shock the market. And that's probably fine. That's probably a good thing. I would say the other thing is as you get all those sensors you talk about, monitoring all sorts of different sources of information, satellites, they're telling you, how many cars are in the parking lots and where the shipping containers are and all this information. Let's face it, most individuals are more and more at an informational disadvantage to the people with the resources. I remember once, and this was old school technology, talking to a woman who's had her own options, commodities futures trading company, and she like me is from Minnesota, and I just want to know how she ran her business. And she was talking about, hiring planes to fly all over the Midwest to look at the crops. These days it's done with satellites, but it's the same idea. She wanted to know whether this was going to be a good year or not and for which crops. That's very valuable information when you're doing, agricultural commodities futures. I made 50 videos about personal finance topics, about investing, insurance, and I taught they're now all on YouTube, but I taught a MOOC, massive open online class on personal finance. And one of the videos talked about futures and options. And one of the things in there, I say, look, like, do you have a plane, that flies over the fields and checks out how the harvest is going to be? Because if you don't, why would you trade futures with someone who knows this stuff and you don't? You're at an informational disadvantage. And that's all over the place. You're at an informational disadvantage, even trading. If you're trying to day trade, you're trading against these wholesalers who know not just what you're about to, they don't just have the same, Bloomberg feed on information and stuff. They know what's happening to order flow in real time. They can see trends. They can see, a whole bunch of small traders are buying such and such. You're just at an informational disadvantage. Does that make it a horrible world? No, but it does mean why compete with someone on something where they're holding, better cards than you are, or they see your cards and you don't see theirs.
Okay, so I want to circle back to one of the questions I started with, which was what's different now? And as you point out, the environment is different. In the old days, news was reported as if it was something that was objective and we all, saw the same news. It seems to me that these days, a lot of news isn't something that's reported as it happens, but it's made by people to get other people's attention. And by the same token, behavior can now be coordinated thanks to online discussion forums like Reddit and others that create attention directing news by people wanting to be influencers. And then you have people like Musk who talks up Dogecoin and boom, it takes off. I also get the sense among younger investors that perhaps there's a sort of a communal aspect to investing to quote unquote support a company and help it succeed. GameStop comes to mind for some reason. But my question is like, what kinds of impacts does this kind of environment psychology have on financial markets?
Let's see. So anything that coordinates the trading of people in a way that's orthogonal to fundamental value, distorts markets, at least has the potential to push prices away from some, sort of vague sense of fundamentals. So if a bunch of people listen to Mr. Musk and he makes a proclamation about something and they buy it, it's going to affect price. And how much it affects prices just ends up being a matter of numbers. If there are a lot of these people and there's not a lot of liquidity in the asset being promoted, the price goes up a lot. How much that matters in the market is, again, it depends. So for individuals, that type of volatility is probably not good because just like with GameStop, some people made a bunch of money, but a lot of people lost a lot of money. And it's often, the latecomers lose the most. The less sophisticated investors often, not always, but often lose. That's certainly on average what we find in our studies. The semi-religious part of it, I think that's not new. What's new, again, is the technology that coordinates things. The fact that if Elon Musk sends out a tweet, millions of people know it, 5 seconds later. You go back 100 years ago, it took a little longer to disseminate your beliefs, even if you were a celebrity. And so that does speed things up. So in a macro sense, it can be a problem for society if the market going up for reasons other than that the economy is improving is kind of a mixed blessing, right?
Not good for markets.
Not good for everybody. It's great when it goes up because the economy is strong.
So Terry, I know we're approaching the end of this hour and you got to hop, but no discussion on investing would be complete without at least mentioning crypto, because anytime I go sit down with young people, they ask me about crypto, right? And they say, what do you think about crypto? And I just turned around and said, what do you think about crypto, right? I really want to know how you think about crypto. So do you have any words on this at all? Like, what's this brave new world of finance going to look like in the age of crypto? Do you have these new things like DeFi and all of that? What's your thinking around this?
So the technology around blockchain, blockchain technology, I think is likely to lead to some improvements. I don't know exactly where those will be, but there'll certainly be improvements in efficiency over having people write things down in ledgers and stuff like that. Undoubtedly, we'll end up with electronic currencies. To a large extent we do. I haven't paid for a single thing with cash since March of 2020. So I use credit cards, but that's essentially electronic money. It's dollars. It's not Bitcoin. We don't have time, nor do I have interest in having a long argument about Bitcoin. I've never been a big fan of it. In part because a lot of the early use, and it still may be true, that might be changing. I don't keep up to date, but it was used a lot. It was the currency of choice for crime. I had a friend of mine worked for an organization and they were getting, blackmailed because someone had hacked their website. And I said to him, so they want to get paid in Bitcoin, right? He said, you bet. So Bitcoin was used for crime. It was used to avoid taxes, avoid regulation. That doesn't mean that the only uses are like that. I'm not claiming that. I'm just saying one of the reasons I didn't like it at the beginning. A lack of regulation. People have different feelings about regulation. To turn to something I know more about, the US stock market would not be the robust, safe place it is today without strong investor protection and enforcement. When you give your money to someone as an investment, your biggest risk is they just put the money in the pocket and walk away. And we don't think about that. The US investor in stocks doesn't have to worry about, these people are just going to take my money, I'll never hear from them again. Because we have serious protections against that type of fraud. So when you invest in a company, your main concern is, will they do well? Will their business work? You don't have to have your main concern be, maybe they'll be really successful and they'll just say, sorry, dude, thanks for the money. I really think, and you'd say, well, of course, that's always how markets work. It's not always how markets work. I haven't written about it. I have friends who've written about tunneling in companies in China, where the controlling shareholders routinely, make loans to their relatives that never get paid, or make loans to themselves that never get paid, make sweetheart deals with their brother-in-law's company. They basically just find ways to expropriate the money of the company that they have control over. We have regulations for reasons. Sometimes those regulations are too complex. We've all run into that. They're sometimes not well thought out. I'm not in a hurry to rush into saying, somebody says, well, I don't want the government to know what I'm doing with my money. You say, yeah, I'll let the government know something about what I'm doing with my money if that is going to cut down on me being blackmailed over someone who hacked my computer or various other things like that.
Very well said, Terry. Thank you for that. And thanks for being on the show. I really enjoyed it, and I'm sure the listeners will get a lot out of it. Thanks so much.
Thanks for inviting me. It's really a pleasure. Bye-bye.